Hey, what is going on today, guys? So there have been a lot of people, kind of freaking out with the whole markets. I'm going to be going over that. Most of the major indexes were down, a couple of percent today. And this video, I'm going to try to be focusing around, really preparing yourself and, kind of going through a checklist of what you really need to have in line for, are you ready for the next recession? Are you ready for a major correction? And, these are just going to be the main topics that I think people really need to take a step back, away from all of the amazing returns that we've had over the past couple of years and, really reflect upon. For those of you that are new, my name is Dan. This is Millennial Investing. And, I've been invested in the stock market for, about 5 years now. I'm currently getting my undergrad degree in finance and information systems. And, I've been, really into, learning about the stock market and reading as many books as I possibly can. And, what we've seen the past couple of days is kind of just a very staple thing in the market. But a lot of people are extremely, scared. And there's a lot of either impulse, saying okay, buy on the dip, or people that's saying okay, sell now because we're due for a recession. And I'm just going to kind of walk through, kind of like a, broad, take a step back and really evaluate, especially for those of you that are newer to the market, kind of where are you mentally? Where are you are you ready for what's going to happen, assuming, say, we do hit a recession, assuming we don't? And I just kind of wanted to walk through that. So as you guys know, that I've only been on the market for about 5 years now. And, myself included, and the majority of people that follow my channel, and the majority of people here on YouTube haven't been invested through a full market cycle. And that means that you need to be invested in both the bull market and the bear market. And, if you've been invested only the past couple of years, you've been experiencing amazing returns. And to be honest, it's not to be expected. Like the past 2 years have been amazing in the market, and they've beaten the majority of records. If you look at 2017, the volatility was at its, I believe, the lowest in history, or one of the lowest years in history. So you definitely can't go off of the past few years of being okay, if I've made money in the past few years and I've beat the market, then I'm good for the next 20. Because you guys know, I invest in tech, and I've invested in tech for the past couple of years, and I've destroyed the market's returns. But, saying I've destroyed the market's returns over the past few years, and me saying that I've just been long tech, anybody who is long tech destroyed the market. If you invest in NVIDIA, the past couple of years, you've made a 10x return on one stock. If you invested in Facebook, you've made a 3x return or something, the past couple of years. If you've been in Microsoft, you doubled your money. If you've been in any of the big tech companies in the world, you have severely destroyed the market. And I'm just trying to tell you guys that, yes, I'm a big growth investor. Yes, I'm a big tech guy. But you have to just kind of take a step back and really understand, what is going on with the market. So I just made this quick presentation to kind of walk through you guys, especially those of you that are new, that are, mainly afraid of what's going on right now. And, I just want to try to help you guys get a little bit more prepared with what's going on. So first things first, you guys really got to understand what you're doing. You're investing in the stock market. Historically, stocks have returned 7% adjusted for inflation over a 40-year period of time. And on average over the past 40 years, every 5 to 8 years we have a correction or a recession, anywhere between 20 and 60%, to the broad market. And over the long term, anytime that we have a recession, the market has always made a new high. And that's mainly because you can take Warren Buffett's approach, and you're just betting on the American economy to continue to, say, make more money. You'll have entrepreneurs that'll come out, they'll solve problems, and they'll make, products and services for people that they'll want to buy to make their lives easier in exchange for money. And it just creates an overall wealth machine. And so that's kind of what you need to look at as the stock market over the past 40 years, at least. Mainly with the U.S. equities. If you look at, say, certain emerging markets, and you look at Japan, not all markets have recovered from their previous lows or consistently made all-time highs. But if you look at, say, the S&P 500, every time there's a major recession, it does make a new high through the next business cycle. So that's just something you really need to keep in mind, that when you look at, say, 2017 and the market went up, I think it was 22% or something like that, that is amazing, but you have to realize what that means. So that means that we had an amazing year, but if on average we return 7%, that kind of means that you need to throw in some really negative years in order to kind of get that 7% number. I know in the past 10 years it's been closer to 12, but in a long chunk, as far as any of you looking out for your investment journey, it's going to be closer to 7 to 9% is just based off averages. That's just what you can expect. And so what you really need to do is you really need to think about, okay, what are you invested in? And this is mainly because you need to know what's going to happen to, like, say, the companies, the equities that you're invested in when you change market cycles. So, like, you know, just a broad thing, you have people that are growth investors, value investors, defensive, speculative, and a blend of all of them. And now, so obviously, if you are growth or speculative, you will destroy, you know, defensive and value investors in a bull market, but you will lag to them in a bear market. And that's mainly because, you know, when the market comes down, earnings drop, and then the things that made speculative plays and growth investments so attractive and lucrative, you know, it goes away because they're generally shown as like, okay, people are putting money into this because they have extra money and they're not really necessities. Or, you know, unlike a value stock, there's not necessarily this raw asset that is worth something that you're looking for. So you definitely have to keep in mind, especially if you're watching my channel, I know a lot of you guys are into big tech, like I am. You need to understand that growth stocks do not perform or outperform the market during a recession or any correction, actually. Like, so like you'll see the big, you know, the big tech stocks over the past week have underperformed, like, say, the Dow Jones. And that's mainly because, actually, the big tech stocks in the Dow Jones have been weighing it down. But if you say look at, like, the pharmaceutical companies to the Amazon, Google, and Facebook, so if you take, like, the FANG names and, you know, compare them to, like, the, you know, Coca-Cola, Johnson & Johnson, Pfizer, all those, you see a drastic difference in the amount of volatility that comes with there. And, you know, if you're young like me, I'm okay with that. I can take the growth. But, you know, if you guys have just been invested in tech and you think that technology will always go up, that's just something you really need to, you know, take another look at. And so you really need to figure out, you know, like, what attracted you to these companies, what can go wrong, because chances are it's going to go wrong, you know, within the next market cycle. You know, it's really difficult to evaluate properly, you know, say a big tech company, because tech, realistically, with getting tech companies this big, has never been valued before, so it's never seen a full market cycle. So, like, you can look at, like, say, Facebook and Google. They have great PE ratios and they have no debt, but they have a really high book value. So who knows what's going to happen, you know, once people start selling. If people see a high book value, does that mean that or a low book value but high PB value? You know, are people just going to continuously pull out their money until it's reasonable for the amount of assets and intellectual property that those companies own is equal to the amount of assets they have? We just don't know, but that's something you really need to keep in mind. Because normally, say, like, if you look at, you know, the dot-com bubble, those companies were just raring hot. Granted, we had earnings growth, unlike in the dot-com bubble this time around, but we still don't know what's going to play out in the next market cycle. So that kind of leads me to my next point is, do you have a margin of safety in your investments? So, you know, say if your company's income drops 50%, what happens? So you guys know that I'm extremely against a lot of debt. I don't like companies that are highly leveraged. It depends on what it is, obviously. Like, if it's a consumer non-cyclical, like a, you know, a tobacco stock or a pharmaceutical, or, you know, like a Coca-Cola or Pepsi, obviously those stocks will stand the test of time because they're going to continue to get their revenues regardless if the economy is doing well or not. But if you have a tech stock that is extremely highly leveraged, and say if it loses 30% of its earnings or not, and it can't pay its debt, you know, something I fear for Amazon, you know, that can lead to a lot of issues, because that means the company's going to have to start selling its assets to pay off the debt, and, you know, companies will either go bankrupt or shrink drastically because of that. So that's just something you have to really keep in mind. And so you really have to figure out, like, okay, if worse comes to worse and my company stops making as much money as it is and it stops growing the way it is, where does it stop? Like, how far does that down does it go? Another thing you really need to keep in mind is, are you fully invested, and why are you currently in the amount of cash that you're in? So, like, you know, for me personally, I am mostly in cash, but I've been putting in, you know, about 30% of my portfolio is in cash. You know, which is kind of conservative to what I normally do. But, you know, that's just because, you know, investing in growth like I do, I try to invest in growth at a reasonable price, and, you know, either a reasonable price or undervalued. And it is really hard to do, especially in the big tech names, unlike it was, you know, like 3-4 years ago. So it's definitely a different ball game. And, you know, like me looking at, like, say, the major tech companies, like Facebook is having a horrible year with PR, and it's just barely making the criteria for being quote unquote valued, like either valued or undervalued for its growth. But then you look at, like, say, you know, an Adobe, or a Microsoft. Companies that are huge, companies that are great, companies that I love, companies that I use, I can't invest in them because their valuations are just too high. Like, they just simply aren't growing at the speed that people have priced them into. And that's something you really need to keep in mind, is that, yeah, those companies don't have a lot of debt. Well, Microsoft does, but Adobe has like no debt. But Adobe's at like a PEG ratio of a 3. So the company definitely is priced in for continuous compounding growth that, if we hit a recession, just goes away. So you definitely need to keep that in mind. And like, is this money, that you're investing in, say, these heavy growth stocks, are you going to need it? And that's kind of like one of the biggest points, is because if you need your money, in the next few years, I'll say, because that's a relatively short span for the market, if you need that money, you're going to eventually make a very emotional decision, whether that's selling at the wrong time, buying at the wrong time. And, you shouldn't do that with your investments, just because it leads to, unintelligent investing, which leads to speculating, which eventually leads to gambling. So be very careful about that. And then also keep in mind, like, depending on how much money you have invested to your overall portfolio, is your income growing as it stops? Have you not even started yet? Like, if you're like me and you're in college, you haven't really started your full career yet. Your income, like, say your earning potential right now is extremely low. So you having, like, you being full in cash means nothing. Because even if you have great returns, it's going to do nothing to your overall life, when you think about it. Like, you would have to get consistent 100+% returns to do anything meaningful to, like, say, you in 10 years. On the other side, if you lose 50% of your portfolio and then you get a job and your earning power quadruples, it's nothing, because then you can just start to take all that savings that you get, live a relatively frugal life, and then you put all the money back in you lost, and you can continue to invest. That's different, though, if you're 50 and you're not earning any more money, and you haven't earned any extra money that you're earning right now in the past 10 years, and you're actually looking at earning power to go down over the next 10 years when you go to retire. You definitely need to keep that in mind when looking forward, because eventually a market cycle will change. Things are going good right now, eventually it goes bad, so you need to really bring it back to that. And again, that kind of brings in my next point, which is, who are you and where are you in your financial journey? So, like, how old are you? Like, for example, again, I'm 21. I have a long time to go. I have the ability to invest more aggressively in growth. I don't really need dividends right now. I don't need necessarily, these defensive plays. I don't need heavy bonds. Like, obviously, yes, being in a bond that says will give you a 2% yield, as opposed to the market that, if it drops, will give you a negative 30% yield. Obviously, you'd rather take the bond, but, the risk premium over the long term, normally at these bond levels, still, in my opinion, isn't justified for me, as someone my age, switching out of stocks and going heavy into bonds. That's why I prefer going into cash. But, if you're, 50 plus, bonds might not be a bad idea, because, you need to count on that money. And again, if you need this money at all in a short time frame, in as far as the span of the market goes, you will eventually make a very emotional decision. And that kind of leads me to the next point, is like, are you emotional towards money? Like, if you become emotional, like, say the past couple of dips that we've had in the market, one, I know a lot of you are saying things like, oh, it's blood on the streets. It's like, no, the market dropped 5-7%. Blood on the streets is when the market drops 35% plus, and people don't know if certain companies are going bankrupt. Like, that's when you hit blood on the streets, and that's when you really need to be aggressive buying. Right now, the market's slightly cooled off, but the market's still at a, historically extremely high value. The current PE, I believe, is about a 30 before the dip anyways. And the forward PE is at like a 20, 25. Like, that is not cheap. I know some people on YouTube come and just say, like, oh, the market's cheapest that it's ever been because of earnings growth. And when you adjust earnings growth to the valuations of equities, no. It's just unfortunate. Like, I'm a big growth guy, do not get me wrong, but that is just not how numbers work. You can you can break out a calculator and do the math. That's just not, we are not in a cheap market. We could be fair valued, or we could be slightly overvalued if you're more optimistic, but you cannot tell me with fact that we are cheap. And so that kind of brings me into I'll leave it with this. Like, if you guys legitimately look at your portfolio, and I know some of you haven't been through a recession, or you haven't been, say, invested in some of the companies, like, say, I've been invested in, like, if you followed me, like, when I talked about investing in Balzum, are you willing to watch your entire portfolio drop 20% within a day? Like, if you're able to, actually have that, kind of, I guess, footing, and you know that you're not going to emotionally sell. You're going to look at like, okay, what actually happened in the company. So like for Balzan, for example, it dropped for absolutely no reason fundamentally. It was just institutional money moved out of the stock. And I looked at the company, earnings were going up, forecasts were going up, and the company had zero debt. So I was like, okay, I felt comfortable putting in more money. And then thankfully I was rewarded, within 2 quarters. And I made a very good sum on that trade. But that's not to say it's necessarily going to happen. Like Balzan could have gone, down another 30%. I don't know. No one knows definitively what the market, what Mr. Market is going to do to your stock's value in the short term. But you have to understand like how you're going to act. You have to understand your emotions and what the margin of safety is with the company that you're invested in. Otherwise, Mr. Market will eventually just whittle you down to where you panic sell at the worst possible time. And that's the reason why some people make money in the market and some people don't. And again, you have to keep in mind that the fact of the matter is that over the long term, the average stock picker severely underperforms the market. And that's mainly due to emotional investing, emotional trading, and just acting irrationally. So that was just something I wanted to touch upon, you guys. I know some of you are freaking out right now, and I do think it's good if you're freaking out right now because things honestly aren't that bad. You could have bought at the top and you lost, say, 10% of your money or so. At the end of the day, that's not horrible. Yes, you lost money, no one likes that, but it's not you lost your entire account or all the stocks that you invested in went bankrupt and you lost everything. If you are freaking out now, though, I highly urge you to really evaluate where you are in the market. Look at where we are on, say, a market cycle, and then how afraid would you be if, say, we started the next phase of the cycle and we hit the recession? If you're not super, like if you don't know 100%, and I know it's really hard to, just say that I'm going to be fine in a recession and continue to buy more or just hold on, whatever, without actually going through it. But you have to honestly ask yourself, are you willing to go through that with the amount of money that you have in the stock market right now? If the answer is no, I would highly recommend, you read either The Intelligent Investor, mainly just Chapter 8. You can read Tony Robbins, Unshakable or Money to Master the Game, or you can read One Up Wall Street by Peter Lynch. And they kind of go through, the emotions of like what's going on in the market, in downturns. And I really just, I hope you guys just don't blow up your accounts at the end of the day. That's pretty much all I can say. I know a lot of you, myself included, are new to the markets, but you just can't get swept into the hype. So I'll leave you guys with that. Hope you guys enjoyed the video. Hope you guys got some use out of this. If you liked anything or if you, have any comments of something that I left out or something that you disagree with me in, make sure to throw it down in the comment section below. And hopefully the markets, rebound in the next few weeks and, you guys get your money back. So hope you guys liked the video. Make sure to leave a comment and I'll see you in the next one. Peace.